Since I last testified here in February, the job market has continued to strengthen and inflation has moved up. In the most recent data, inflation was a little above 2%, the level that the Federal Open Market Committee thinks will best achieve our price stability and employment objectives over the longer term. The latest figure was boosted by a significant increase in gasoline and other energy prices.
Conditions improve. The Fed faces critical decisions with respect.
The solid pace of growth so far this year is based on several factors. Robust job gains, rising after-tax income, and optimism among households have lifted consumer spending in recent months. Investment by businesses has continued to grow at a healthy rate. Good economic performance in other countries has supported U.S. exports and manufacturing. Also support clear and open communication about the policy. Core inflation was 2.0% for the 12 months ending in May, compared to 1.5% a year ago. We will continue to keep a close eye on inflation with the goal of keeping it near 2%.
Thank you for our phone call the other day. I know you know this.
Looking ahead, my colleagues on the FOMC and I expect that with appropriate monetary policy, the job market will remain strong and inflation will stay near 2% over the next several years. This judgment reflects several factors. First, interest rates and financial conditions more broadly remain favorable to growth. Second, our financial system is much stronger than before the crisis and is in a good position to meet the credit needs of households and businesses. Third, federal tax and spending policies likely will continue to support the expansion. And fourth, the outlook for economic growth abroad remains solid despite greater uncertainties in several parts of the world.
Mr. Scott.
Thank you, Mr. Chairman.
It is difficult to predict the ultimate outcome of current discussions over trade policy, as well as the size and timing of the economic effects of the recent changes in fiscal policy. Overall, we see the risk of the economy unexpectedly weakening as roughly balanced with the possibility of the economy growing faster than we currently anticipate. Over the first half of 2018, the FOMC has continued to gradually reduce monetary policy accommodation. In other words, we've continued to dial back the extra boost that was needed to help the economy recover from the financial crisis and the Great Recession. As always, our actions will depend on the economic outlook.